Welcome to Ahead of the Curve. I'm Susan Lisovicz. My next guest says that it doesn't matter, despite the uncertainty and fear, there is a solution. So let's get right to him. Stanley J.G. Crouch is the CEO of EXP Wealth Enhancement, which is owned by Aegis Capital, where he's also Chief Investment Officer. Welcome, Stan.
Thanks, Susan. Great to be here.
You know, a lot of people right now are fleeing for the hills in terms of investments. That means like just putting it under the mattress, doing nothing with it, trying to ride it out. It's been years now, but you say there's a better way. What is it?
Well, first of all, it's very understandable for people to have fear because the volatility, the event risk out there. We've seen what happened in 2009 where basically the market crashed from the fall of 2008. It came back substantially, but that doesn't mean the next time it will. History is rife with periods of pretty, long, drawn-out market downturns, and so plus the macroeconomic situation is very scary. The world seems to be slowing down, so we're very concerned about that. What we say is that most portfolios, the reason this is so, they've been so rooted in this idea of growth. And
stock price.
Yeah, and speculation on the future price appreciation. We think that people need to get back to the core roots of what investing's all about. Graham and Dodd, famous twosome that wrote the seminal work on security analysis.
And Warren Buffett's hero, right?
Well, more than that. Actually, Mr. Benjamin Graham, or Dr. Graham, was a Columbia professor, and Warren Buffett was one of his foremost students and became actually a protege, was the only person to get an A+ in his class. Now, the reason that Graham and Dodd wrote that book was because Graham got wiped out in the crash in 1929, and he really re-examined his life and his ideas about economics and his philosophy of investing. And what he basically came down to is companies are in business for one reason, in his mind, to share in the form of dividends their operating cash flow with their owners, the shareholders. And I think we've gotten away from that. So when Warren Buffett really got what's called value investing, but what we do is actually much even deeper than value investing, we look at it like Mr. Buffett does. If it makes sense, if it cash flows, it's something I want to own. And so take much less to no risk in terms of price appreciation and really get rooted in the math of the cash flow.
Okay, so you're looking for the dividend.
The dividend and the coverage of the dividend, the sustainability of the dividend. Something people forget. In the Depression, at the bottom of the market in 1932, the dividend yield on the Standard & Poor's 500 index was 13.84%. Current return on your cash. What that tells me is two things. At that time, after the market, forgetting about the crash of 29, after the crash, the
companies
market,
were still paying.
They were paying, and the market lost 78% of its value.
But companies were still paying.
Exactly. Companies were paying that dividend, some, and no one wanted stocks. So the dividend cash flow was on sale, on a fire sale.
Yeah, but fast forward, they're not paying that anymore.
Exactly, which is why, well, there's two things. One, we worry about the market based on that history because you can't have your cake and eat it too. Wall Street tends to tell people, although past performance is no guarantee of future results, that boilerplate language that the authorities make them say. But they really tell people, you've got to be invested in equities as a preponderant part of your portfolio because equities have had the best returns, particularly since 1926. Well, when you unwind that and dig a little deeper, you're going to find out that the dividend cash flow and reinvesting the dividends in more shares to buy more cash flow and so on gives that exponential effect, and that's responsible for at least half to more than half of the total return. But in our modern era, it's become this growth. Everybody wants growth, and people still shun the idea of a dividend.
So you have to look even harder to find these stocks. Is that what you're saying?
You have to look harder, but you have to unwind your conditioning and uproot your mindset to say, hey, maybe things There's a reason I'm flat to negative for a decade. For 10 years, it didn't work as they told me it would work. And going forward, we've got all these economic challenges. Maybe it won't work for the next 10 years or 20. What do I do in retirement if I'm not making those returns? We say that's too risky. So what you do is, if you get a cash-on-cash return and you compound, you're going to make money. How much? We don't know. What rate? We don't know. But at least if you're committed to that cash flow strategy, compounding is unassailably valid. And that's the point of this. The other thing is, if the market falls, because everyone says they're a long-term investor, but if you put up a screen on Fifth Avenue that has a huge thing of the market during the day, I'll bet you well over half the people walking by will look and stare and wonder what the market's doing today. And you can measure their emotional response. If the market's down 300 or 400 or 500 points, they're going to be depressed.
They're not going to buy 2 pairs of Pradas.
And exactly. And they may not be really caring about that for 20, 30, 50 years or ever if they're passing it on.
But let me ask you this, because if we're going to talk about Warren Buffett and value investing, a downturn is a good thing because that's when your valuable companies go on sale. So are you saying that look for income, look for that dividend, but also you should be looking at the stock price? If it's really come down a lot and you look at the historical performance and the industry that it competes in, wouldn't that be a factor too?
Of course. You know, you need to do an evaluation and make sure that you're paying a reasonable price for the cash flow. That's very important. That's what we do at EXP Wealth. We are expert in making sure that we're taking our own proprietary model and making sure that we're looking at that cash flow and paying the right price for the cash flow. But if the market declines over time, I mean optimally, and people might not want to hear this, but if you put in X amount of money into the market and you commit to a dividend reinvestment program with bonds and equities, what ends up happening is you actually, if you're committed to this exponential effect, you hope over the next few decades that prices decline, that rates go up, that stock prices go lower, because you use the cash flow over and over to buy more and more cheaper value, as opposed to sitting in cash and saying, I think the market's going to go down, and I'll enter at the right time. Nobody knows that. It's impossible to know.
So you can't pick the bottom or the top of the market, but what you can pick is that steady cash flow that comes with things like dividends.
Right, and make sure that you select wisely. And what we would advise always is, how sustainable is it going forward? Believe it or not, there are companies that actually borrow to pay their dividend. That is just crazy, because how sustainable is that if I've got to go borrow? The other thing is, make sure the company doesn't have a lot of borrowings in front of it, because the dividend is last to be paid. The equity is the owner. So you got to make sure that the leverage, the amount in front of you, either borrowed or preferred shares, is low to no. So we own companies that have no debt and lots of cash, and they keep generating cash flow. Those are the things you want to own going forward.
Words of wisdom from Stanley J.G. Crouch, who is the CEO of EXP Wealth Enhancement, owned by Aegis Capital, where he's also Chief Investment Officer. Thanks so much for joining us, Stanley.
You're welcome.
And you've been watching Ahead of the Curve. I'm Susan Lisovicz. Thanks for joining us. We'll see you next time.